My name is Tyler Yell with Daily FX Education Team. But what we're going to be talking about today is some of the key correlations in the market, and it's an exciting time for us to look at this, given that we've had this stall in the dollar rally over the last month, given the Greece elections we have now, and the big moves we've had in other markets, whether it's oil, metals, equities, and yields, and we'll take a look at all of those. So I'm glad the voice is back, and let's go ahead and get on with the show. A bit of housekeeping here to begin with. The risk disclaimer states trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. And then the hypothetical performance slide, we're going to look at some trends. We're going to look at correlations that have worked in the past and some that have broken away, and some that are realigning. All that to say, past performance is not indicative of future results. And with that, let's get on with the show. So we're going to take a look at a broader view here, kind of the interconnectedness of some markets. And the idea here is, in no uncertain terms, to be able to identify trends that are developing and being confirmed from other markets. You've likely heard the saying, birds of a feather flock together. And so what we want to find out is what's moving in tandem and what patterns are available for the market that you want to trade. Right. And so we'll look at those patterns across correlated markets. Now, I'm going to use some screen grabs and things of that nature to help explain some of the stronger correlations and some of the trades that are engaged right now. We're going to talk about some that are setting up and opportunities that we'll be keeping an eye on. So we have a lot to look at today. But again, if you guys have questions, please ask them in real time. I think that's going to be the lifeblood of this session, and that's going to make sure that you get the most out of our time together and walk away with something of use. All right, so let's just take a look at the big picture here in terms of intermarket analysis. Basically, intermarket analysis is another word for correlations, and it's saying that what happens in one market is going to affect another, right? So we're going to look at commodities, FX, bonds, equities, to really see, okay, where is their opportunity present? The thing that I want to kind of bring up front is that this can help clear a path for some confused traders. It can also bring some confirmation to traders who like to see, okay, is the wind blowing in the direction that I'm heading, right? And if so, I just got to set the sail, so to speak. So with that, let's take a look at a few market themes going on right now. We've seen the dollar stall, but not fall, right? And that's something that is encouraging to, I'll tell you, a lot of banks and a lot of individual traders. Now, on one hand, some people are looking at this as the dollar has topped. I'll tell you, very few institutions are looking at it in that manner. Most of them are looking at it in the sense of, yes, we've lost traction, but we haven't fallen in terms of the dollar index. In fact, I'll have some real-time charts up as well that you guys will be able to see. This is a FXCM Dow Jones Dollar Index. The difference between this index and the DXY, probably a more popular index overall, is that this is equally weighted against yen, euro, sterling, and Australian dollar, right? Whereas the DXY is 57.6% weighted. So at first you look here and you think, oh, well, there's really nothing doing. Well, that's a 4-hour chart, and you'd be right over the last month, right? This has been what I like to call a squirrel in a trash can, right? It's moving, but it's not making any progress. And so with that, and I've got some levels there to keep an eye on, this trend is still in focus. And the argument being that we might just be setting up for that next push higher. And there are implications if that's the case. There are strong implications that we'll talk about today, as well as some specific currencies that could really benefit off of that move. But looking back at that kind of big picture that we were just talking about right there, this looks temporary. And what's interesting is that we're seeing some commodities kind of take it back by this move in the dollar and other markets, right? So one thing we're seeing is oil. So oil's been consolidating, and it seems like there is room for a push higher, but by all means, it looks like it's just position settling. And what I mean by that is that quite simply, you have a lot of short covering, you have a lot of money on the line here with oil, and moves in the oil market are erratic at best, especially around the bottom. One that I've shared with our clients at Daily FX is to look at the bottoming process in 2009 in U.S. oil, because yes, we've had this nice bounce here, right, off of that 43. But I'm just going to go ahead and take this off, some of these tools off, and I want you to look at what oil did in 2008, early 2009, when it finally reached its bottom, right? And the idea here being that both sides are likely going to get hit pretty hard. And what's interesting, and one of the correlations we'll be talking about, is the correlation to CAD and somewhat to euro in oil. And so that's going to help us as well. But you can see here, we recently in oil this year hit that 43 level, bounced up to 54.21, and we've since been consolidating sideways. You can see here, we bounced from a lower level in 2008 off of this 36 zone, came up to 56, right, higher than our current peak, and then dropped down aggressively before actually kind of forming this bottom. So not saying it's going to happen exactly like this, but just to show you that there's going to be some erraticity around this low. However, one of the correlations we'll look at is naturally going to be the U.S. dollar and oil. And put those moving averages back that we'll be keeping an eye on. 21 days is an interesting one, and rightfully so, and the impact that's going to have on some CAD trades. Naturally, we talked about the Greece debates. I'll tell you, the way one bank is looking at this is that the market is effectively pricing in a deal, and with that, the risk is to the downside, meaning that we've already covered the dollar. The dollar's stalled, but it hasn't really fallen. And so what we're looking at potentially is a rosy outlook as being priced into the market. But if you get a fall, or if you get a no deal, right, which makes the weekend gap risk extreme, I would say this week, if there's not a deal by the end of today's trading, if there's not a deal, then that dollar strength could come rushing back. And we'll talk about some levels to focus on for that. Gold has potentially carved out a rather bearish scenario. Also, that affects dollar. That's going to affect some other markets as well. But if gold continues to drop, that's going to have a very key effect on dollar yen. And because of that, that's one of the trades that a lot of banks are really excited about. While it might be slower to continue the trend that some banks would hope it would be, dollar yen is still setting above support in its recent formation over the last few months, while at the same time still having those complementary pictures, I would say, from other markets, whether it's equities, whether it's treasuries, that effectively is going to give that confirmation on the breakout in dollar yen that we could see a move into the upper 20s. And then here, maybe a market that some of you don't pay a lot of attention to, some of you might love it like I do, we are seeing a strong move higher in yields, right? So government yields, whether it's Japanese government bonds, whether it's U.S. treasuries, we've seen yields push higher, meaning that effectively that dash for safety, which historically has helped gold and has helped or strengthened the yen, is coming off. And so that helps clear the way as well. All right, this is one I want to, just a concept I want to put up here, which is that an open mind is going to help you bring these together, bring these concepts together. Naturally, by looking at different markets and seeing how different markets are reacting to economic themes, that's going to hopefully allow you to stay in good trades longer. All right, if you guys are familiar with Jesse Livermore of Reminiscences of a Stock Operator fame, the excellent speculating book written in the 20s, there's a quote there that I love. And that quote is, "Do not give me timing, give me time." The argument there being when a trend is in, right, and I'll have another quote from that book here later on, but when the trend is in, really one of the best things a trader can do is to recognize they are right and sit tight. Right? That's also one of the hardest things for traders to do. But when you have these themes that are all pushing in the same direction, that can be a very helpful tool. All right, so let's take a look at some of the different markets that are moving and some of the correlations that are there. So again, if we can kind of surmise the markets we'll be looking at. Of course, Forex, that's the one that we're going to be looking at trades based on, but we'll also take a look at commodities, equities, and yields. And I'll try and explain the effect that those three markets, commodities, equities, and yields, have on specific FX pairs. And I'll even have a correlation graphic up for you guys, or a matrix, if you will. And the purpose of that is to kind of help you see, okay, what's the strongest correlation or potentially inverse correlation here that could help me find a trade. So one of the first markets, and some people call this the heart of the market, right, is treasury yields, right? And what's interesting, this is a chart, the screen grab I took from the trading room that I host on a daily basis, the Daily FX on Demand trading room. Again, and I'll give you guys the access details to it. We have an open house, so if you guys want to check it out, you're welcome to, no strings attached. But what's interesting, this is the US 10-year yield, again, sometimes called the heart of the market, correlated to gold, correlated to yen, very, very much. As yields push down, and some of you may not know this, which is perfectly fine, yields are inversely correlated to the price of treasuries. Put another way, as people continue to run into treasuries out of fear or out of other poor global economic developments, the price of treasuries push higher, the yields push lower, right? So we've had this rather interesting debate, if you will, of is one leading the other? Is yields leading stocks, or is yields leading something else? I don't like to buy into the leading concept. It goes back to the correlation is not causation, right? It's not as much as do bonds lead stocks or do stocks lead bonds or anything of that nature. To me, these are different markets that don't necessarily link or de-link. These are different markets that have the same, I would say, the same offer in a different risk-adjusted form that really different macro fund managers are approaching. So that being said, this push lower in yields on the US 10-year, we'll take a look at some others as well, really showed uncertainty as well as a preference of this bond market over other bond markets, right? So like the Bund, right, or the Japanese government bond or something of that nature, which did in fact help the dollar over 2014, right? We started off a little bit shaky when this was making its least amount of progress, and then towards the end of the year, right, that's when the dollar really began to take off. I'll tell you though, what's really interesting to a lot of banks, and we have a good question here, is yield is interest rate. So yield is a rate. It's effectively what price people are willing to accept over a fixed period of time. So a fixed yield over a fixed period of time. It's seen as a safe haven, right? And so there is a amount of risk adverseness when people are buying treasuries, which drop the yield. Well, here's the important point on the far right side of the screen. I won't spend too much time here because it's not a trade we can look at, but I want to show you we have this strong push higher, and now we're looking into the 200-day moving average around 224. If this is in fact a major low, which it's possible that it is, then that means that equities could move much higher, and we could see potentially yen crosses move higher, which will be selective on that. We'll talk about which ones might be more favorable, as well as gold lower. So this is the next kind of chart I want to show you. I'm going to use different correlations here. I'm going to show you a correlation matrix, and I'll just point out two or three of metals, of FX, and of oil. The idea here being that, okay, these are major markets, right? Daily there are billions, if not trillions of dollars focused on these markets. So let's see what information is being really passed on from one market to another based on these correlations. So the first one to look at is gold. And what I've done here is taken an inverse correlation, right? And so why it sounds, theoretical and maybe complex from a mathematics point of view, it's absolutely not. What we're looking at here is the idea that if gold is pushing lower, there's less fear, right? In fact, if you guys remember in 2009, 2010, there was this popular fear trade. Well, obviously you don't hear about that anymore because any fund that employed that, especially with leverage, has been wiped out, right? Because the fear trade was to buy gold and to sell the S&P, right? Well, the S&P has nearly tripled since the 2009 low, and gold has almost been cut in half. And with that fear that gold is really, I would say, bred upon is of inflation, which obviously we're not dealing with right now. That's why the ECB had to engage in their quantitative easing in late January, as well as the energy, which is a temporary effect likely, but oil coming down is also hurting the inflation picture from a global perspective. Okay, so what I want to show you here is that if gold continues to drop, which I do want to have some real-time charts here for you guys, just so you can see things that are happening in real time, right? So this is gold, and gold's really, really interesting because we potentially have a very negative picture in gold. And that very negative picture in gold would be that this move here was a corrective top. Now, I'm not sure if you guys are comfortable or familiar with Elliott Wave, or if you're comfortable or familiar with Ichimoku, but the argument here simply states if we break this lower high of 1166, then what potentially could be in store here is for lack of a better phrase, a route to the downside. So this is the weekly Ichimoku cloud. This is a long-term trend following indicator, right? And this hard asset, which again, hard assets often perform best in times of inflation, which we do not have. But looking at it from this standpoint, if this was a resistance point and we're about to break through 1166, which you can see here, we're currently facing a couple forms of support, right? We've got the trend line off of this low, right? We also have a 786 off of this range here. The argument being that at very best, we're close to a turn, but few things are suggesting that because a couple of things, right? Gold is inversely correlated to yields, which I showed you that chart earlier, has been popping higher for most of February. Gold is also inversely correlated to yen, right? Which has been stable, if not in this long-term, yen crosses in this long-term uptrend. And gold is also inversely correlated to equities, right? Some are at all-time highs, or you have the Nikkei, which is like an 8-year high. That being said, should those other large market trends continue, right? There's going to be probably more downside for gold. And a very good question here. The short answer, we had a question on is there a and Black Cat, great question. We'll talk about that in just a moment. The question came in, is there a correlation of gold to South African Rand? And it's what we'd call an insignificant or a less significant correlation, not one of the top correlations to help us develop a trade idea. However, I would say that gold naturally is going to be one worth keeping an eye on in terms of dollar yen. And if dollar yen is pushing higher or there is some yen weakness, right, that often is going to favor some I would say at the very least, also favor some upside in dollar rand. All right, so the metal correlation, the key thing I want to point out here is you can see there's an inverse correlation to yields, which going back to this chart, and I'll have another chart on yields in just a moment, have been pushing higher, hurting gold. You also have yen crosses, right? And the argument being that if we do in fact see, let's go to dollar yen here, if we do in fact see this sideways consolidation just run out of steam and then finish higher, which is not a guarantee. Please understand, I'm a trader. I'm a trader first, and guarantees are not in the lexicon of a trader, at least a good trader. But looking at this, if we break, and I'll tell you the level I'm keeping an eye on is this 2080. While not a trade recommendation, have entry orders above 2080. Then naturally, I think that'll continue to play out that gold weakness potential view. So here is the kind of big picture on metals as far as we're looking at it, right? As of now, for other markets like equities, bad news just seems to roll off the market's back, right? Like water off the duck's back. This is another quote from Reminiscences of a Stock Operator, whereas anytime somebody was looking for a big drop in equities and a bad news event would come out, there's this they called him Old Turkey in the book, but there was this old trader who would just look at a bull market and say, I can't get out. It's a bull market, and that's the environment that we're in now. You can see here, yen strength is conducive to gold strength, i.e., if dollar yen and other yen crosses are dropping aggressively, that's often good for gold, but we haven't seen that lately. And also looking at the equity picture, we're sitting at all-time highs. We could get a correction, but calling a top has been a fool's game in equities in this QE environment. And then you can see down here, gold yields and let's put yen yields and gold correlation is realigning. All right, so let's next look at, and that's another view of that chart I was showing you, which effectively just shows you the daily Ichimoku cloud. So the price we came into on gold is also, so I mentioned this is a longer term view, right? That's the weekly Ichimoku. If I go down the daily Ichimoku, you can see we came into the cloud. And really, if we did break that 1166, that would show a reversal to the downside there. All right, so let's look at some of the majors, and you'll notice some of these themes start to overlap, right? And because of that, hopefully, as you hear more, we've got about 20 minutes left. As you hear more, some of these will begin to kind of favor each other, if you will, or we'll kind of hammer the idea in the head a little bit better. So this is majors, and what's important about some of the majors, and we are going to look at yen again, but what I wanted to do here is just kind of help you see how a lot of these are intertwined, right? So one of the common yen correlations is dollar yen is inversely correlated to gold, something we just looked at, right? But also dollar yen is inversely correlated to copper, as well as Kiwi dollar and cable, right? What's interesting about that, or I think what's at least helpful for that, is just to know that the dollar strength is going to have a key effect there. When I look at the dollar, right, we have a momentum peak. This is a 5-period RSI, and RSI has been trailing to the downside. This is a channel drawn off some key pivots back in October. And with that, you can see we've had this sideways move. Now, of all the majors, I would say cable has probably benefited the most from this sideways move. So if we go over to the majors, right, and this is the chart. Let me go back to, this is what we started looking at on the day. That dollar index here, we'll be looking at resistance in this zone, and that's going to be in this kind of 11,812. 11,803 range. If we do break higher, guys, it's possible that this was just a sideways consolidation that is ready to resume higher. I had the question earlier, if the thesis is for gold to trade lower, why didn't gold trade below 1130 with the greenback going so strong? We don't know if the greenback is done yet. And at the time that gold hit 1130, that at least for me was a bit of a washout, and it was a bit of an event where we had yields still continuing to press lower and lower and lower. Please understand that I'm not trying to say I know the future. We just want to look at some of the larger trends and what the implications would be should those trends continue across different markets. Based on the dollar index, and one bank I think put it very, very well. Just saying that the dollar has stalled, but it has not fallen. And the idea behind that is that this effectively could be a sideways move, right? And if you look at, we'll take a look at some of these majors in just a moment, like euro dollar and cable. If you look at some of these majors, right, this is not an exciting bullish setup, right? You've got this sideways move. Maybe if 1450 breaks, we have a little bit of upside to around this 1660 level, right? Just taking this prior zone and looking for a 382 move, right? But even then, that's still going to mean there's limited downside for the dollar index right around here, if that does in fact play out. But looking at the DXY or looking at the FXCM Dow Jones Dollar Index, it appears that the dollar is correcting. And if that does develop, right, then for me, when I look at Euro USD, any break below 1270, it could be a very strong continuation. I mentioned gap risk with the weekend. If you look at cable's been an interesting one, and you'll see here I have something called a strong weak matrix run across a few different currency pairs. The argument effectively being that over the last month, sterling has been the strongest. And even if the dollar does resume its stronghold move that it had, from really October, I should say July, to the end of January, it was the strongest month after month after month. I guess January you could say Swiss was the strongest, but that wasn't a very tradable move for a lot of people. But all that to say, this is still not one I would sell. In fact, I would look at some sterling cross trades, right? So if oil continues down, it's the market we're going to talk about next. If oil continues down, there's pound CAD, right? Pound Aussie is another one to keep an eye on. And so all that to say, this is cable, sterling USD, and the argument here is that we've had a nice push higher. I will be looking for roughly a 50% retracement because you can see a lot of consolidation in this realm to potentially catch the bottom of any type of corrective move. Either way, though, I really wouldn't be excited about selling sterling in the current environment, even against the USD. I think that there's weaker currencies, so to speak, to buy the dollar against. We took a look at dollar yen. This one, again, I'm just going to let play out. I've got my entry order at 120.80. And on the downside, naturally, a lot of downside yen cross trades are difficult in the sense that they're quick and they bounce aggressively. So given the overall trend, I have an entry at 20.80. It means I'm not going to buy the bottom, and I never try to. But all that to say, that's one that just kind of a patiently wait. And of course, if you look at equity indices, right, you've got an 8-year high. This looks like it's just going to continue on. Now, we have seen a divergence from the Nikkei and dollar yen, right? So if I do an overlay here, used to have such a clean correlation. That's recently broken away. Part of that is due to some of the jawboning, if you will, from the BOJ, right? So this blue line here is dollar yen. The candles here are Nikkei. And you can see it's recently diverged, but to me, the overall relationship hasn't changed. Naturally, there's some cyclical components to the Nikkei doing what it's doing, right? And there's also some talk from the Bank of Japan that in the current environment, further easing is counterproductive. But it still seems that the larger environment favors dollar yen upside. Jin Sora, thank you for the question. Guys, thank you so much for the questions. I do appreciate them, and I do think it makes this a better session than without them. Jin said, are you saying DXY is going to what level high? I'll tell you, there's really been no material damage to the underlying trend. When you look at a long-term DXY picture, I mean, if you look at, the 2002 high, right, in the DXY, I mean, we just effectively came into that 50% retracement. So to me, it's one to continue looking at higher. I don't really look to call a top or a certain level, but I think I think it was around 102 or 103 is the 618 of that 2002 2011 range. So effectively just continuing to look higher. I hope that helps, Jen. All right, so all that to say, yes, momentum has stalled, but if we get a breakout of RSI and we continue to the upside, and I mentioned the FXCM Dow Jones Dollar Index levels that I'm keeping an eye on, effectively it would be a break of this 813 to show me that game is on, right? That the dollar strength is back, and probably the way I'd be playing that is either Aussie potential downside, potentially as we're going to look at next with oil downside, so dollar CAD upside or euro dollar downside. All right, let's take a look at the next market correlations, right? That's going to be energy. So when looking at energy, the things that kind of stand out to me and that I think are at least worth discussing, there's a strong inverse correlation to dollar CAD and oil. There is a positive correlation, interestingly enough, of euro dollar and oil. But the one I want to spend the time on, because euro dollar has enough troubles of its own, and thankfully to technical analysis, we have some rather clear levels. Those clear levels being 1270 on the downside. This support shelf gives way, then I think that we're in the process of heading back down, effectively heading back down to this 110.97, excuse me. And what's interesting, and one thing that not a lot of people have looked at as far as I'm concerned, but what's interesting here is that quite simply, if you take a look just at the height of the triangle, right? The argument being that there's a triangle formation within here, right? If you take the height of that triangle, let me take this off. We hit that target to the downside. That takes us to around 107, which gives us a pretty clean next target if we get that resumption of dollar strength. So around 107.40, 107.50. So that being said, given what we've seen in the dollar index, right, if this is just a breather, if this is just a rest stop, so to speak, before the trend continues higher, that 107.50 level looks like the next attractive level if 110.97 breaks. So again, we've got a clear picture with euro in my perspective, right? Going to oil's been very erratic. And one thing that's been helpful is Brent. Now, we've seen the spread widen in the sense that from a premium standpoint, Brent used to command a premium that collapsed during this crash down here, and it's since re-widened. Here's the thing I want to look at, right? Sometimes the simpler the better, right? Occam's razor. Looking at the 21-day moving average, I think is really all you need to do with oil. It's done a great job recently, and until we move below it, right, I don't really want to get aggressive on looking for some further CAD weakness. And the reason why is here. If I go to this chart, and I'll tell you up front, I am a diehard Elliottian in the sense of, as a chartered market technician, and I know CMTs that hate Elliott waves, so it's not just because I'm a chartered market technician, but I've seen few things that at least help explain pre-trend moves, which was my last webinar here at FX Street. Pre-trend moves better than Elliott wave, right? But all that to say, it looks like we had a corrective high here, right? And now have the potential to see another move to the downside. Now, that's not so much a dollar move as I think it is a potential oil and CAD correlated move, right? Some people are coming up with that and saying, you know what, I think CAD yen then would be one to keep an eye on, right? Because yields are pushing higher, gold is pushing lower, and oil is able to hold above. And in fact, I just saw Michael Jacob put that up right on top of it, man. As we look here, if we can hold this 21-day moving average, right, I'll tell you, it's probably a tactical short-term trade, but there is that potential for us to hold above this shelf for a while, this 21-day moving average, and CAD yen, which I don't even think I have that chart up. Let me just pull it up here. CAD yen to continue to benefit short-term, right, from that strength in oil, which correlates to CAD. All in all, and I'll tell you, this is one that's been interesting to me. Just a Fibonacci target was hit on the downside into a shelf of support on CAD yen. Nice 618 touch there, and then just going back, you can see that this has been a zone, right? Effectively a 250 pip zone that CAD yen has really not wanted to trade below. Right, so all that to say, if we do in fact get oil continuing to move higher, and Michael Jacob, hat tip to you, buddy, then CAD yen could absolutely be an interesting one. But looking at just the structure of oil internally, I'm going to go down to a smaller term chart. I took some of this off as we were as we were looking at the 2009 backdrop. This is another way to kind of look at oil. Right, and since then we've actually traced out something similar to this, right? And I can put these pitchforks out, but really what we're looking at, guys, 47.36 and 48.06, right? That's a 70 cent range, excuse me, in oil that I think is worth keeping an eye on as support, right? So if I go back to here, I'll draw it up real quick. Appreciate everybody's patience, and if you guys want to ask some questions, we're coming into the end of our time here. Sticky mouse. All right. So this is now the level that we can look at as support. If that continues to hold, right, then effectively I would expect this to break. And if that breaks, there could be some CAD strength. Right, again, short term, you could look at dollar CAD. It looks corrective. Euro CAD is another one. Oh, man, that thing I think could rock to the downside. CAD yen has, from what we've talked about today, I think an inner market support to it as well. Right, especially if we stay above that 21-day moving average in that 21-day moving average in oil. All right, so just some last moment slides here. And this is more just kind of a breakdown of the majors here. So the dollar, we've talked about it sideways, correcting, and given the correlations, dollar strength often means commodity weakness because they're priced in dollars. So if we see that next leg higher, we could soon see the next leg lower in gold or oil or things of that nature. Again, keep an eye on that 21-day moving average in oil. Euro, it looks corrective, but there's been a ton of support at 1270. If that breaks, excuse me, I think we could see 110.97 again, the January low, and then 107.50 appears to be a clean triangle target long term. Cable, it's been called the poor man's dollar by some bank traders. Right now it's the leader of the pack, and so it's nothing that I'd want to short. In fact, might be a tactical long against some other weaker commodity crosses like Aussie. Aussie's an interesting one. I had a question about the Australian dollar, and I appreciate that. The question was, what is it correlated with? So it's recently been correlating with equities and with yields pretty cleanly. As I currently look at it, I would say, excuse me. All right. As I would look at it, I would say that we're effectively in an environment that does support near term some Kiwi, and I would have to say if you look at Aussie Kiwi dollar would probably be the preference there. But naturally, Australia, and you can see that note that I put there, has weathered a lot of bad news recently, Chinese data, employment data, things of that nature, but has kept that higher low. And so that's going to be one continuing to work to watch. Outside of that, yeah, I don't agree. I don't disagree with you there. Michael said EuroCAD has been messy to trade on the short term. I think there's a clean amount of support such that if it broke, I think that could give some CAD strength worth playing on, especially if you get Grexit. You can see here, guys, CAD's handcuffed to oil. We've talked about that. And then yen effectively driven by yields and risk. So again, if yields are pushing higher, right, that likely means that dollar yen is also pushing higher because there's not that fear there. People are leaving the safety of treasuries. Those are selling off. The yields are pushing higher and going to quote unquote greener pastures, right? This is a simpler way of saying what I just told you with the majors, and that's that running a calculation here on a 4-hour chart, putting a 200 period moving average. Right now, the strongest is sterling and the weakest is Aussie, right? So Aussie can come up some. But net, it's not an attractive buy, especially against some of these stronger currencies, the dollar, sterling, or Kiwi. All right, so here's the conclusion, and then after this, guys, I'll present you the open house details, and you guys are welcome to ask me any questions or shoot me an email because I know we're running out of time. The idea here that we've looked at today is that intermarket analysis builds on single market analysis, which is most common. Really, what we're looking for is the wind all blowing in the same direction, right? If so, that's very helpful. As of now, guys, I think the dollar has stalled, but it has not fallen. It is important to note, right? Because if this is a sideways correction, from my experience, sideways corrections just denote a strong underlying trend, not enough conviction to take it effectively lower, and a sideways correction can precede a sharp move higher. Naturally, we talked a little bit about the Nikkei. We didn't look at a lot of equities because they're at all-time highs, and that favors yields higher, gold lower, and yen crosses higher. The VIX, we didn't talk about that much either. We had a bearish break. It all says the same thing, and that's kind of the point of the whole session, is that really what we're looking at is that fear has left once again. Even with Germany and Greece and those debates, the fear is really not ever present like some thought it would be, and that's going to continue to be supportive there. And then you can see here, lastly, the banks are hesitant to leave the dollar bull camp, rightfully so, which would be bearish for commodities. But guys, with that, I just want to say it's as always been an absolute pleasure speaking to everybody at FX Street. I appreciate your time today. And if you guys do need to reach out to me, please don't hesitate to. Have a great weekend, and I'll trade well until I see you guys next time.